How are investors positioned in this market going into the second quarter?
Well, we have seen this great rotation into small caps and transportation, some retail, particularly as we're talking about anything related to home goods and also consumer discretionaries. And that's where the money continues to grow. In terms of the actual NASDAQ and the big tech and the mega cap, yes, they are definitely being impacted by the rates and the recent rise in rates, and they've been under pressure underneath their 50-day moving average. But then again, so are the small caps. So what's really has to happen here right now is that I think the whole market wants to see these rates ease a little bit, and they actually did by the end of the day at least come down a bit from their highs. So I think that we're also, even though the Archegos situation hit the banks because they lent margin money to the company, they actually are holding up pretty well too. So I think what we're seeing right now in terms of the normal value, as I said, retail, small caps, transportation, which made all-time highs, that money will continue. Banks, I think, will continue to get some money. And in terms of big tech, it might be right now waiting for the next quarter earnings to come out. And if they see anything in the remotely optimistic, you could actually see money going back into those growth stocks pretty easily. I would watch for those March 5th lows to hold and any kind of turnaround here, as I said, in the rates.
And now, Christy, as we kind of talked about there at the top of this segment, Brent crude and WTI are both trading lower month to date as ships resume moving through the Suez Canal. Now, the attention is now on that OPEC Plus meeting on Thursday. How are things shaping up with that?
Well, Saudi Arabia is likely to urge OPEC and its allies to extend the existing 1 million barrels per day production curbs through May at Thursday's meeting. So the fact that prices are selling off is telling us that investors think that this may not be enough, especially in light of weaker demand in Europe and softness seen in China. European countries are tightening movement restrictions further amid yet another spike of infections, and the U.S. is also reporting higher new infection rates despite accelerating vaccinations. And Reuters cited that Russia, too, was willing to back a further extension of current cuts, but it also wanted to secure approval for a moderate increase in its own production to respond to higher seasonal demands at home. So WTI fell about 1.6% from May delivery, and Brent fell 1.4%, though both still remain up more than 20% year-to-date so far. Prior to this latest bout of weakness in the market, expectations were that the group would start easing cuts more aggressively from May as we head into the summer driving months. However, it seemed like the expected rebound in demand has not materialized at all. The reopening trade has not been as aggressive as forecasted, so it will likely mean that OPEC will take a more cautious approach, and it's increasingly likely that OPEC will hold output levels basically unchanged to avoid another sell-off.
And Michelle, we alluded to this at the beginning of the segment as well. President Biden looks to reveal the scope and ambition of his new spending plan this week. What is expected from this infrastructure plan, and what does it really mean for the economy and continuing to stimulate that as he's been trying to do since he took office?
Well, to answer the first part, it's a very wide-ranging infrastructure that is basically based on a slate of proposed tax increases, both to companies and to the wealthiest. So they're planning to spend millions of dollars on roads, bridges, broadband, domestic manufacturing. They want to boost research and development funding. They want to improve caregiving for the sick and the aging. And basically, to pay for that, they're looking to raise the corporate tax rate to 28 from 21, and the individual income tax rate from 37 to 39.6. Plus add an unrealized capital gains at death. So essentially, Biden is calling himself the Lyndon Johnson 1960s Great Society and the FDR 1930s New Deal type of situation. That, of course, didn't exist at the time, but climate change is a big part of it, too. And, of course, this whole idea of China and trying to deal with China, with the SEC now looking at delisting some of those China stocks, or as Biden said, because they're going to eat our lunch if we don't do something. In terms of what this is going to do for the economy, no one is going to argue with the fact that an infrastructure package is desperately needed in this country for many reasons, not from just job growth, but even for morale, as we continue to slip behind Asian countries in terms of our infrastructure. As far as though the taxes and the costs and the spending, that's where I think we'll start to see some sticking points and how effective, if any, agreement can be made between the two sides of the fence.
Michelle Schneider of Market Gauge and Boom Bust's Christy I, thank you both for that analysis today.